We are excited to have our last webinar for the year. And so as people filtering in, I'll quickly make an introduction. So today, what we're going to talk about today, I've got Amy Cowling, who's one of our provisional financial advisors, just got authorized yesterday, today?
Yeah, I think yesterday, potentially.
Yeah, I think we backdated it to yesterday, but it was done formally today. So that's very exciting. So today, what we're going to talk about, we are talking about how to protect your biggest asset, which is you. And we're talking about the role of personal insurance in building a strong financial foundation. So today, we are, well, quick disclaimer, everything we talk about is general information. Don't take anything me or Amy say and go and implement it for your own personal situation. But just, it's all general information. Don't do anything silly. So the agenda, what we're going to talk about, hopefully this webinar won't go any longer than an hour. We really do want to spend time discussing any questions people have. We find that provides the most value is when we do these Q&As. So throughout our presentation, feel free to write any questions in the chat functionality somewhere. If you're on your phone, you can put it somewhere. If you're on your computer, it's on the right hand side of the webinar. But what we're going to talk about is we're going to talk about what constitutes a strong financial foundation. The second thing, we're going to talk about your income. So your greatest asset is your ability to earn an income. We're going to talk about the different types of insurance covers and personal insurance covers, and then the common misconceptions about personal insurance. So I think we've got 5 myths that we often see when we're talking to clients, and the data just doesn't back up a lot of these common myths. And then we'll talk about case studies and samples of what personal insurance means at a claim experience. And then, as I said, the Q&A. You can write any questions throughout this webinar. It will be recorded and put online. So if you do, if you do have to jump out, you got kids to put to bed. I know Amy does, and fortunately my kids are out of the house, so they're not getting put to bed at the same time. So if there is little kids running in Amy's background, then we all have young families, so we can excuse that. So to start off, we are going to, or Amy is going to talk about what constitutes a strong financial foundation.
Perfect. Thanks, Phil. So first of all, I'm just going to chuck a poll up for people to go through whilst I'm talking about this section. But basically, we want to know a bit about you. So how would you describe your insurance knowledge? Check that one out. And then also, what stage are you currently up to with getting your insurances sorted? So in terms of a strong financial foundation, there are a few key areas that make up that strong financial foundation. So firstly, here we've got a fully funded emergency fund. Now, what that means is making sure that you've got that emergency fund sitting there for an emergency. This is not needing to go to a concert and having to buy last minute tickets. This is if you have an actual emergency, you've got funds there. You don't need to dip into a credit card to do that. Then we've got a regularly updated budget. So know what you are actually spending. Make sure you create that budget, review it often, know where your money's going. Then we've got growing a superannuation balance. So the big thing here is people actually knowing where their super is, what it looks like, read those statements as they come in, make sure you know all about your super so that you can watch that grow. Then next, we've got our no consumer debt. So things like credit cards, personal loans, car loans, get rid of those. Make sure that you don't have any consumer debt or what else is known as bad debt. And then we've got a stable place to live. So making sure that you're obviously got somewhere to live, whether that be a rental property or having a mortgage on your own home. So having a look at this screen, we've come to our first question for those in the webinar. And basically, I would love to know from those in the audience tonight, what is missing from that strong financial foundation? So if we're looking at all of these things that builds on a really strong financial base, what is missing from that picture? So chuck in your answers in the chat. And for this, we do actually have a prize to give away to the person that can name it first as to what we're missing there. So we've got Imelda, estate planning.
Good
Great
guess.
answer.
Close.
Not the one I'm looking for. Shannon, insurance. Perfect.
Ding, ding, ding.
So what's missing here is a protection plan. So we definitely need some insurance in place. And leading from that, what our greatest asset is. So I'll pass over to Phil to talk about that, and we can figure out why insurance is so important there.
Awesome. Look, Imelda, estate planning is good. Insurance forms part of estate planning, and so that is a good answer. But Shannon, we will reach out to you after the webinar, and we'll send you a book. And so, yes, the foundation. Financial foundation, that's the word I'm looking for, is insurance. It's super important. So, what is your greatest asset? It is your income. Your ability to earn an income is your greatest asset. A lot of people think it's, my superannuation balance at retirement or my house is my greatest asset. And that makes sense because it's your biggest individual, purchase will be your house and using a bank. But, some of the things, your ability to earn an income is often underestimated in terms of how much value that creates. You're not buying that house or paying off that mortgage without the income. You're not, having that superannuation asset without an income. So this is a person who is 30 years old and working till age 65. So another 35 years until retirement. And the median annual full-time income of $83,200. Now, when I was 30, I wasn't earning that income. So this is the average across Australia, the medium household or the medium full-time income. And assuming this person has a salary increase of 4% each year, and there are no breaks in that salary. So just every single year, it just increases slightly. So the lifetime earnings of this individual is actually $6.372979 million. So $6.4 million as lifetime income. And so it's really important to think about when we are building, financial foundations in place, that we think about that our income actually plays a huge part in that. You can't build an emergency fund without your income. You can't, save up superannuation assets without an income. So protecting that income becomes really, really critical to making sure that we are protecting the downside of any potential risks. So next question. What is the remaining lifetime earnings of a 25-year-old earning $150,000?
So there's a bit more detail in the chat there. So we're assuming up to age 65, 25-year-old earning that $150K a year, increasing by that 4% each year as well.
And any 25-year-old is earning $150K a year. Well done. Congratulations. You're doing great. Anyone want to have a stab at the answer? I actually don't know the answer. I can have a guess as well.
25-year-old.
So we've got 40 years and 150K. Is it like, anyone want to have a guess? All right, I'm going to have a guess. It's like $12 million? 20 million?
Somewhere in between the two.
Oh, wow. More than 12. 9 million, no. Stephanie, go more. Somewhere between 12 and 20. 16.
Any final guesses?
18. It's like an auction here.
It is.
What's the answer, Amy?
We've got 14.25 million.
14.25 million. Well, Shannon already got a book, so I'm going to give it to Stephanie. We'll reach out to you as well, Stephanie, as to how we get the book to you. So someone will send it out to you. It'll be me over the next 2 weeks because I'm away. I'm in Brisbane from tomorrow. So now, one of the things, Amy, is people often talk about, well, if I don't have an income, the government will help me out. And given that your career before financial advice was working at Centrelink, you're a great person to talk about this.
For sure. So there is potential for the government to help you in some circumstances if you're unable to work. However, there is a lot of things that you need to consider when you're just solely depending on the government helping you out if you can't work. So if you are disabled and you're looking to claim the disability support pension, or potentially you're looking to care for somebody else and claim the carers payment, both payments are very similar in the amount that you can get and the way that they're assessed. So the maximum that you can get on either one of those payments would be about $1,144 a fortnight, which works out to be about just under $30,000 a year. And that's for a single person that's not working at all. If you are working at all, then you need to declare that income, and then the amount that you can receive for those pensions is reduced dependent on the income. And you also need to meet an impairment rating. With the disability support pension and the carer payment, if you are partnered, that does drop down to about $862 a fortnight. So it does drop quite significantly if you're partnered, and then your partner's earnings do also reduce that. So if your partner is earning over $99,000 a year, you will receive absolutely no disability support pension or carer payment. So it's just something to consider as well. And in terms of the condition, it needs to be diagnosed, reasonably treated, and stabilised. So if you're waiting for surgery, if you're going to get better within the next 2 years, then it's not something that you would qualify for disability support pension for. In that case, you may be eligible for a job seeker payment. And the rate for that one for a single person is $786 a fortnight, or just over $20,000 for the year. But you also have a requirement to look for work. At times, if you are totally incapacitated for work, you are able to provide medical certificates so that you don't have to look for work, but it's still only around $20,000 a year. And then again, if you're partnered, your partner's income will also reduce that rate. Oh. Skipped a slide. NDIS is also something that comes up quite a bit. Will the NDIS support me? NDIS support me if I'm unable to work? So the NDIS is not meant to replace wages or to be treated as income support. It's more there to assist in terms of supports of getting better or rehabilitation and that sort of thing. But one thing with the NDIS, as you'll see from all of these headlines here, it can change quite dramatically and quite rapidly depending on the government of the time. So I'm sure everybody has heard recently about the cost blowouts with the NDIS and the way that everyone is trying to rein in those costs and make savings and all those sorts of things, tighten the shoestrings with the budget. And that basically every year the government puts out a budget and they tell the NDIS, struggling to say those letters, how much they can spend in terms of what they can budget for people. So if the budget is reducing from year to year, then there's going to be cuts. There's going to be things that can't be supported. And so you're really open to that government changing those supports year on year, depending on who's in government and what needs to be done at the time. So while there are some supports in place from the government, it's always good to have your own plan in place so that you don't need to be wholly and solely reliant on the government if something was to go wrong. So I'll hand back to Phil now to go through the different types of policies and types of cover.
All right. So at the start, we did do a poll. Now, most people answered with, I know the basics. So how would you describe your insurance knowledge? Know the basics. So I'm going to talk about the basics of insurance types. What are they? How they work? This may be above people's knowledge, maybe below people's knowledge, but we really just want to talk about, like, just give us a ground knowledge of what is personal protection. So life insurance or death cover, depending on if your super fund sets it up or your advisor calls it death cover, it basically pays out a lump sum benefit if you die or you're diagnosed as terminally ill. So you've got less than 2 years to live. Now, what this pays for: income replacement for your family. Can cover debt. There are other things that you can build in a certain amount to pay for a funeral, things like that. And again, when we talk about like government support, government doesn't support a death payment, and so there is no kind of backup scheme from a government support point of view. Next is total permanent disablement or disability, TPD. So this pays a lump sum benefit if you become totally and permanently disabled and you're unable to work ever again. The things that we want to think about when setting up this cover is, do we want to cover any debt? again, do we have any medical expenses? So if I'm totally and permanently disabled, will I incur medical expenses? Statistically, yes, you're going to incur significant medical expenses, depending on what the reason for that disability is. And then also you won't be able to work. So, having enough money to replace an income is super important. The next one is income protection. And this is kind of like the core cover that we like to talk about. This is, in my view, the most important cover because, as we said at the start, the most important asset is your ability to earn an income. If you're 25 earning $150,000, what was the number again?
About 14.25 million.
14.25 million. If you're 30 and you're earning, $82,000, then we're talking about $6+ million. So your ability to earn an income is incredibly important. So what income protection is, it pays a monthly benefit if you're unable to work because of an illness, injury, or sickness. And the maximum you can be insured for is around 75% of your salary. So it does depend on insurance contracts and types. Each insurance contract will have a thing called a waiting period. So how long do you need to wait before you can get paid a claim at claim time? So, health insurance talks about the waiting period at the time you take out the policy. How long do you need to wait before you can claim on it? Income protection, the waiting period is at the time you are ill, injured, or sick. How long do you need to wait before the insurance company will start paying your monthly benefit? The next thing is benefit period. So that dictates how long you will get paid for. So the most common ones are 2-year benefit period, 5-year, or till age 65. So what that means is if you are unable to work for a short period of time and you go back to work after 6 months, well, great, your benefit period doesn't matter. But if you can never return back to work again, well, and you've got a 2-year benefit period, then your payments stop after 2 years. And then you're reliant on, government support or family support as well. And so, the core purpose of income protection is to replace a portion of your income. The next one is trauma insurance or critical illness cover. And so this pays a lump sum benefit if you are diagnosed with a serious illness, the most common one is cancer. That pays over 50% of claims. Heart attacks is another one, strokes, but there's a whole list of conditions that if you are diagnosed or your condition has a specific severity, then you get paid out a lump sum payment. And so what we think about this is we want to cover some medical expenses that may be incurred. So if you have cancer and you're going through treatment, we want to cover some of that cost. And the other thing is income replacement. So you may be off work because of one of these, medical events. Now, trauma insurance is different to like health insurance where they rebate a certain payment that you've made for medical expenses. This is just a lump sum payment. Whatever you're paying for will get paid out into your bank account. So if you spend less than the total amount of insurance cover you have, then that's great. You bank that money. But on the opposite can be true. You may not have enough insurance cover to cover the full cost of the medical treatment that you're going through. And then child's insurance or child's cover is another one. So this is pays out a lump sum if your child is diagnosed with a serious illness, such as cancer, deafness, neurological condition, as well as passing away as well. So again, this can be, cover medical expenses, and it's just a lump sum payment if one of these things happen. So it can take time off work for the parent because my individual income protection won't pay out if one of my little ones is sick. So that's why I've got child's cover, because if one of my girls were ill or really sick, I'm definitely not coming back to work. I want to make sure I'm spending time with my girls and taking that time off. So it funds that ability to do that. And then also, like if the children are in the hospital and you want to be close to the hospital, it can fund some of that expenses as well. So anyone who's been around a child illness or knows of someone knows that there can be significant cost involved if something was to happen. So next poll, Amy.
Chucking it up now. Should be in there. So we've got, what's your biggest concern about getting personal insurance? So there's just a couple of options there. What's holding you back currently from getting insurance? So while everybody answers that, we can move on to the misconceptions.
But before we do that, Amy, just quickly,
Sure.
just touching on the poll at the very beginning, we asked, what stages are people currently at with setting up their insurances? We had some people saying that they're starting the process with an advisor. Great job. And others said that they've got insurance but want to review or make changes or upgrade their cover. And then someone just coming in saying, hey, just want to learn about it. How does it all work? And so the biggest concern about getting personal insurance is the premium cost. The next one is claims process. And then, please add comment. I don't know how to see that comment. We'll work it out.
Anybody that said other, if you can just chuck in the chat what your biggest concern is.
Yeah. All right. Go ahead with some misconceptions.
Perfect. So the first myth that we've got here is I'm sufficiently covered by my super fund. So with that myth, here is basically some things that aren't covered by group cover or the policies that your super fund provides. So trauma insurance. So Phil just touched on what trauma insurance is and when it pays out. And this is a policy that you can't actually get through your super fund. It needs to be owned outside of super. And the reason for that, along with some of these other premium features that I'll talk about in this section, the reason that they need to be owned outside of super is that they wouldn't actually meet a condition of release for you to be paid it from your super fund. So these particular features and benefits can only be owned on a policy that's done outside of super, and therefore your group cover doesn't cover that. So that includes trauma insurance, the own occupation TPD feature. Now, what that means for anybody that hasn't heard of that before is that your TPD cover within your superannuation that you might have, for anybody that has a default policy or anything like that, that any occupation means that you would need to be unable to do any occupation that you're reasonably suited for based on your education, training, and experience. And at times that can also include being having some relevant retraining to be able to go into a different occupation. If you're able to do that and you're still able to do a job that's not necessarily your own, then you might not satisfy that definition of being able to be paid out that TPD payment. With the own occupation feature, which can't be owned in the group covers, you need to be unable to do your own occupation or your daily duties of your own specific role. So for instance, if you're a nurse, really hands-on, and something happens that means that you can no longer be hands-on, under that any occupation definition, you might be able to transition to like a nurse on the phone, giving some consults over the phone. Whereas if you had that own occupation definition and you couldn't do your hands-on nurse role, then you might be satisfying that TPD definition and therefore more likely to get that TPD amount paid out. The policies also have to be owned through super with group cover, meaning that they're attached to your super fund and fully paid for by your super. And that also leads to that next circle of them being tied to your super fund. So if you get down the track and decide that the super fund you're with is not really for you and you're wanting to switch to a different fund, your insurances are stuck with that fund. So you either need to try and transition those across, or you could potentially lose them altogether. With a retail policy, it's not tied to a particular. Basically, the insurer retains the right to renew the policy. So they may no longer offer cover to certain groups of people or occupations and things like that, or the underlying insurer for your particular super fund might actually change. So currently, for instance, Australian Super has TAL as their insurer. They might then change over to a different insurer down the track, at which point those policies can potentially be rewritten. So it doesn't necessarily get renewed from there. And so you just run that risk of it not being renewable. If you have that retail policy in place, the only time that they can not renew your policy is if you stop paying your premiums. So that one's completely on you. So then we'll move on to myth number 2.
All right. I just want to go off script because, you know, it's the last webinar of the year and I want to freak you out a bit, Amy. But I was on a podcast. It came out today with Glenn James from Money, talking about those point 3 and 4 is really important. Like there was a comment in the Facebook group that said they had moved super funds, didn't realize that their policy hadn't been, transferred over, and now they're totally and permanently disabled, and their TPD covers less than a year's worth of income. So that's kind of my biggest message is not linking your insurance with your super fund. And so when you set up through a financial advisor, you cannot link it to the super fund. And that's super important because it means you can move super funds as many times as you want without having to go through the insurance process. So second myth, it's not worth getting it if I get an exclusion. So exclusions happen. What that means is you go and apply for cover and the insurance company says, we're going to cover you for everything except for mental health because you've got a existing, condition with regards to mental health, or you've hurt your back recently. So we're not going to cover you we will cover you for everything except for your back. And so one of the myths is, is it really worth it if I've got this exclusion? And at the end of the day, insurance is just all about math. The reason why I love insurance so much is it's really just about math. It's about, what is the likelihood of me claiming on this contract? And is it worth the premiums that we pay for it? So when it comes to exclusions, because statistically you're more likely to claim on that area that you've got a pre-existing health concern on, the insurance company wants to negate that likely claim in the future. But when it comes to exclusions, the majority of exclusions are things like mental health, things like backs. And so even those major exclusions, they do make up, less than 20% of all claims. And these stats is from one insurance company. It takes their data from 2008 all the way up until 2020. And so this is the largest insurance company in the country. And this is stats for males and females under age 55. The reason we use that is because some of those cardiovascular cancers skew really high for over 55 to 65-year-olds. So we try and just look at it. And also majority of the people we work with are under age 55 as well. So, 28.6% is for accidents and injuries. Now, exclusions don't include accidents and injuries. So you won't get an exclusion on your policy for an accident. In fact, there are policies that will only cover accidents. And so when we look at exclusions, even if we've got a family history that causes an exclusion or we've got a pre-existing health condition that causes an exclusion, a lot of people think about that being a major concern, which it is, and it's something that we've put a lot of effort into trying to minimize. But majority of claims will be outside of that exclusion. And so insurance is definitely worth it, even if you still have some exclusions. Myth number 3.
So myth number 3 is that insurance companies don't pay for claims. So at Skye, Phil's going to go through at the end of this a couple of real life situations of where we've had some claims paid out for some of our clients. But this is some claims acceptance rates, again, from TAL, and this was for the 2023 calendar year. So you can see here there's quite a high rate of death and life paid out. Why that's not 100% could be things like they do generally pay out on the death or life cover if somebody's terminally ill. So that could be things like just determining whether that terminal illness actually meets the grounds to have that death paid out prior to death. And then also people can submit claims for any of these, even if they don't actually meet the grounds of being qualified for it. So maybe they haven't spoken to their financial advisor and confirmed that they have actually got a critical illness that's listed in their product disclosure statement. And so they've made a claim on trauma for something that's not actually covered. The insurers still need to list that in their stats of a claim that hasn't been accepted, even though it's a claim that would have never been paid. So these, considering all of that, they're quite high rates of claims acceptance across all 4 types of cover that Phil has spoken about already. Do you want to add anything to that one before your next?
You know me too well. So I do want to add some information. Income protection is like the most highly claimed on policy out of all of them. And insurers do try and add a bit of color to why they have some declines. From memory, around 3% of the decline, so there's 4.8% of claims that have been declined. Around 3% of that is because of a non-disclosure. So when you take out insurance, you got to fill in a health declaration. And so if I've applied for cover and I have either unintentionally or intentionally not told the insurance company about a condition that happened before I took out the cover, and then I go and claim on that condition, the insurance company, at the time they assess the claim, they'll look at your health history as well. So they'll look at your medical history and they'll say, hey, you actually went to the doctor 6 months before you took out the contract and you indicated that you had some concerns in this area. and now you're trying to claim on it. And so they do decline. So about 4% is because of a non-disclosure. Also 3% is for non-disclosure for that income protection. But I'll stop geeking out. So myth number 4, personal insurance is just too damn expensive. That was the highest rated concern that people mentioned is, excuse me, is, we in the poll, what is your major concern about getting personal insurance? It's the cost of it, so the premium cost. Now, one of the things about personal insurance is it can be customized to fit your budget. It's the thing I actually love about insurance, and I've said that multiple times in this webinar, and I shouldn't declare my love for insurance that much, but I do, is that it isn't a, it's not a I should buy it or I shouldn't buy it. It's like when, we're going through the car purchasing process at the moment. We've got all this list of, believe you me, I've got an Excel spreadsheet with all the pros and cons of every single car. I've got my preferences with the weightings of my preferences. I've got my wife's preferences with her weightings of what she wants in a car. But, when we buy a car, there is a, do we buy one or don't buy one? But it's also, do we buy, not that we're looking at a Lexus, but, that's the most expensive car I can think of. A Lexus, do you buy a Kia? Do you buy one new? Do you buy one, 10 years old? And that will determine a lot based on your budget. It's the same with personal insurance. So do you get the Rolls Royce of the insurance that you need, which is the best, the highest sums insured you can get with all the features and benefits? And if you can afford that and you want that and that's important to you, then great, you can go and do that. But you can go all the way down into getting a, 40-year-old car, if you will, in this analogy. I'm trying to stretch this analogy to make it make sense, but stick with me, Amy. It's the last webinar of the year. You can get the oldest bomb possible, but you've still got a car that moves you around. So it's the same with insurance. You can get the best insurance, or you can dial back on those features, dial back on the levels of cover, and just get something that's really basic that'll just cover the basic needs for your insurance needs. So a large, and then also on top of that is a large portion of your premiums can be funded through your super fund. So you don't have to go to your super fund to increase your cover to set it up, but you can go through a financial advisor and get majority of that cost funded from your super fund. And so that's great just for cash flow management and also tax benefits. As well as some of your premiums can be tax deductible as well. So at the end of the year, you may get a tax refund. But the thing I love about insurance is you can dial up or dial down, based on your overall needs. And the last myth we have,
that it's cheaper to get cover within my super. So this was actually a bit of a project for Skye earlier in the year. We had a look at our last 500 clients and had a look at comparing their current super fund and what the cost of increasing their insurance with that fund was versus taking out the level of cover that we recommend with the retail insurer that we recommended, and compared those costs to each other to determine whether it is actually cheaper to just increase your cover with your super or to take out that retail cover. Now, the results might surprise some of you, but basically it generally does work out reasonably cheap if you're looking at low-level default cover with your super fund. But as soon as you start increasing those levels up to cover some of the costs that you actually need to cover when you're looking at things like total and permanent disability and getting income protection at the right level for your income, you can see by this little table that we've got here that it's actually only one insurer, being Aware Super all the way down the bottom here, that came in cheaper than the retail policies that we were recommending. So in this table, we've got 421 clients overall. There was some that the super fund or the insurer had less than 5 clients, so we haven't included them in the figures here. But CBUS Super, all the way at the top, 133% more expensive to keep your cover with CBUS and just increase your cover to the level that you need than it was to go with a retail insurer for that cost. So more than double the amount, and the same there for Spirit Super, more than double the amount of taking it out with a retail insurer. And then some of the others down here are generally around that sort of 50 to 80% more expensive. So it is often much cheaper to go with a retail insurer. And if we ever do recommend a client move their move their insurance across from their super fund to a retail insurer and to cancel their super insurance, then we would show the comparison with this and show what it would look like increasing that cost through your super fund versus taking out the retail policy that we're recommending. And we show those figures to show you really whether it's worth switching across or not. But definitely busting that myth that it's cheaper to just go with your super fund.
Yeah, this was the first 4 weeks of Amy's work. As soon as she started, we're like, hey, here's a project. Compare these costs for 500 clients. So that was a good project. And CBUS is in the news a lot recently. So
yeah,
let's not talk about CBUS. So case studies. So case studies are always interesting. They're always about, getting claims paid out. Now, we've got clients who go through these really difficult times in their lives. And the benefit of our work is that, yes, we are helping people set up an insurance policy. Yes, it is a bill that we have to pay every single year or every single month that comes around. We've got to keep paying this bill. But it is for a purpose. It's if something bad or something really bad happens, there's money in the bank for it. So we had a client who renal cancer, carcinoma, male, 33 years old, married, no kids, $500,000 mortgage, 100% working from home, desk job, data nerd, I'll call him, underwent surgery, required a recovery period of around 6 weeks, and got paid out a claim of $185,468. And so, the reason why it's a little bit odd numbers is because if you're paying 4 years of premiums, but you claim in the middle of the year, they'll refund a portion of those premiums. But this client didn't actually have that much time off work. And so they did have a recovery period. They definitely didn't spend $185,000 on medical expenses, but that's how trauma works. It's a set amount that you pay for and you get paid out at claim time. So the next was, a female, 27 years old, single, no mortgage. And the client was a software engineer who has a flexibility to work from home, but she took 3 weeks leave to undergo medical checkups in Taiwan. This was actually a really funky claim because she went to Taiwan and because she was in Australia and went and had some kind of concerns, and the GP said, yeah, we'll recommend you go to a specialist. And the specialist said, it's going to be like 3 months before we can see you. And this client, I got to really make sure I don't say anyone's name. And so this client decided her family lives in Taiwan still, and she's from Taiwan. She knows the medical system really well there, and she can go and get treatment straight away to check what's going on. Went to Taiwan, stayed with her family, and then they found out that she had stage 1 renal cancer, and so they were able to do surgery and pretty much get back in Australia fully treated before the original Australian specialist appointment was going to be booked in for. So that was a great experience for her. She had that flexibility to go to Taiwan, but she had the time off work because after surgery, she needed to stay in Taiwan longer than she originally planned. And so got paid out $152,830 as a lump sum payment. Now back at work, again, didn't actually spend that much in medical bills, but just had that money available if, in future, because, she'll be having to do, every regular checkups as well for just to make sure that cancer doesn't come back. And then the last case study was chronic fatigue syndrome. And so, female, 34 years old, single, psychologist, no mortgage, but had debts. Took a week off to undergo health checks and had reduced her workload to 30%. So because of chronic fatigue symptoms, spent some time out of the workforce, pushed herself to go back to work because of the financial constraints we all are under, having to go to work. And so really kind of pushed herself, and her health actually took a backward step because of that. And so this was an interesting one where we were able to get income protection paid even before technically she should have, because as advisors, I was working in this case, the insurance company, at Skye, we are one of the biggest insurance advisors in the country. So I was able to really paint a picture for the insurance company to say, hey, I think it's best for the client to start getting paid as soon as possible so she can stop going to work because she's forcing herself to go to work to pay her bills. And I think it's better for the insurance company if you start paying earlier. And the reason why I made that case is because it's chronic fatigue syndrome. If she's pushing herself to go to work and the insurance income protection is going to last till age 65, the more she pushes herself, the worse her health will get and the longer that claim will be. And it took a bit of toing and froing, and the case manager declined it, and then I had to go up to the national claims manager. They declined it, and had to go even further to basically head of operations and say, hey, I think we really should get this paid for these reasons. And fortunately, they came to the table and decided that, yes, it's in everyone's best interest. And I got pretty grumpy that they weren't considering it. But it's a good reminder of going, this is what income protection is for, it's not just because we need the income, and that's true, we definitely need the income, but it just allows us to go, oh, actually, I'm going to take time off to really get on top of my health issues, to really make sure I'm healthy and I'm at my best to go back to work, because it'd be in the long-term interest of our client who's claimed and long-term interest of the insurance company. So Q&A, we want to give an opportunity to ask any questions. We've gone through a bit. I hope it's been super helpful, but if you do have any questions, please just write it in the comments, and we'll be able to answer them live. And if you do have any questions after the fact, and you don't want to ask in this webinar, reach out to us. Happy to any of our team to jump on the phone.
We do have one question in there already, Phil, if you want to have a go at this one. I think it was when you were talking about the cost of premium. So what's the most expensive premium for personal insurance that you've seen? Keen to know the range.
Yeah, I mean, I'm trying to think of what's the biggest premium I've seen. I did see someone who was recommended premiums of around $30,000, I'm going to say. Now, this client was like head of marketing for Nike Australasia or something ridiculous, like significant income. That's normally the most expensive policy is income protection. So when someone's got a really large income that needs to be covered, then that can generally increase the cost. We generally at Skye, we work with, like, our average client age is 34. So our premiums are generally, when we look at the industry, it's not as big as the normal industry, but yeah, $30,000 a year was probably the largest premium I saw. But yeah, in terms of like the lowest, I mean, we've got clients paying, a few $100s in premiums. So yeah, it's a big disparity.
So I've got one here from Jasper. Are there any discounts for maintaining a healthy lifestyle, such as non-smoker status, regular exercise, or meeting specific health criteria? So with this one, healthy lifestyle, non-smoker status doesn't necessarily get you a better rate, but being a smoker will definitely get you a worse rate. You'll have loadings on your premiums due to being a smoker, and that can include vaping or the occasional smoke as well. Regular exercise or meeting specific health criteria, there are a lot of insurers that do healthy lives discounts of some description. They all differ from insurer to insurer, but generally you can get a couple of % depending on your BMI, so how healthy you are in terms of that. And some of them also do offer some extra discounts and things like that for doing exercise. There's some companies like AIA that have a health benefit linked in there, but it will all just depend on the particular insurer that is most suited to you.
Next is from Shannon. Good. This is a great question. I like this question. Did company pay out during COVID? Let me start again. Did companies pay out during COVID, or is it exempt under acts of God? There isn't actually exemptions on that under acts of God. There are like acts of war that insurance companies won't pay out on. So let's put that aside. I won't talk about any acts of war, but did they pay out over COVID? Yes, they did. There wasn't many, in fact. We've actually got a client who kind of had like long COVID, chronic fatigue type symptoms, who's still on partial payments. And that was since she got COVID. And there's been no issues whatsoever. with her payments, and she's still on partial. So, but the other thing when it comes to insurance, during COVID actually wasn't a big contributor to claims in terms of people, passing away because of COVID or anything. It was actually the biggest issue for insurance companies is people weren't able to go to doctors for 2 years. Telehealth is great, but it prevented doctors being able to look at, someone's, arm and go, oh, maybe we need to do a skin check, or maybe there's some concern there. So there are more claims these days from health issues that not have been ignored, but weren't able to be treated as well during that COVID period. So things like cancer's gone up. Claims on cancers is increased post-COVID. Cardiovascular claims have increased significantly post-COVID. And the insurers, when I talk to the insurers, it's all about those, the lack of ability of, getting and seeing a doctor, especially anyone who's from Victoria like me. We were locked inside.
So the next one is, how can I book directly with you, Phil? Would love to sort out my insurances.
Yeah, you're going to answer it, Amy?
Oh, you can answer it if you like.
No, I want to hear your answer.
So Phil doesn't do any client-facing phone calls and things like that at the moment. He is looking at building the business so that we can meet our big audacious goal for 2027. But there's a slide just after this that will have a QR code where you can book with any of our advisors to have a quick 15-minute call. And then you can also jump onto the Skye website and book with any of the other advisors. So you just jump in and basically have a look at when the most suited time is for you. And one of us will give you a call and just have a quick 15-minute chat over what the process looks like.
Yeah, I thought you were going to say I don't do any real work, which is kind of our internal joke. But to that point, we've got amazing advisors in the team who all do great work and are much better advisors than I ever was. And so my job in this business is to, scream up and down and try and get as many people insured as possible, because I'm crazy passionate about getting insurance in place. And the amount of availability to get insurance advice is reduced significantly over the last few years. So that's my job in the business. But these amazing advisors are the ones that you'll, when you book in a phone call, you don't get to pick and choose which one you like. If you want to catch up with Amy and you want to book Amy, you can't actually pick and choose. It'll just get allocated. And that's the reason for that is because we just want to be able to allow as much time as possible. And so, different advisors will allocate their calendars to be open during the time of the week that suits you. So you go on, you book in that phone call at a time that suits you, and then we've allocated it. So, Amy's not on the phones 100% of the time or none at all. Next question. Krista has said, I've heard someone say that income protection should be purchased outside of super, but I can't recall hearing the reasoning. Go, Amy.
Okay, so this one, we have a look at this as part of our recommendations and determine whether it is most suited for you to have it inside or outside or a combination of the two. So in most situations, we will have most of it set up within super. And then with some insurers, you will pay for a small portion of it outside to get some better definitions and things. So like the chronic fatigue where you might receive a partial payment if you're only working some of your hours, you can't actually get those types of benefits with a fully owned super policy because it wouldn't meet the conditions of release from super. And so we do look to sort of split your policy a little bit between super and outside super. Some insurers allow us to hold it wholly within super and still have those benefits. And in terms of holding it wholly outside of super, we would do that for people that are on a higher income, where there is a tax benefit for them to hold it outside of super. So the policy itself would still operate exactly the same. It's just how it's paid for. And if you're paying for it outside of super, you can claim a tax deduction for it. So if it's going to be more beneficial for you tax-wise to hold it outside, we would recommend that during your advice meeting. And it looks like we've got one last one there. If you want to take that one, Phil.
Yeah. So how do insurance companies verify your health status at the time of the application to ensure what can be included or excluded from the policy? So there's a thing called a personal statement. So that's a massive health question. So the way we help our clients do it is they do it over the phone. So it's a tele interview where the insurance company will ask a whole bunch of like yes, no's, and then tell me more. And so in terms of verifying it, so if there is an area of concern for them and they want a doctor's report to verify what you've said is accurate, they'll do that. They'll go and request a doctor's report and they'll pay for that as well. So if they feel like it's needed, then they'll pay the doctor to get that report to them. And so that's how they verify the information. But at the end of the day, they kind of trust that, you know, everyone applying for cover is an adult. They've got a duty to take reasonable care not to misrepresent their health status to the insurance company. That's a part of the contract, is a duty to take reasonable care. And so at the end of the day, if you tell them something that is false, at claim time, they will just double check, hey, was there anything that we missed at the application stage? And if you met your duty to take reasonable care and you didn't intentionally mislead, but you forgot about something when you were 5 years old that you may have known, then they can't use that against you because you've taken a duty. You have met your duty to take reasonable care. So they kind of, insurance companies both treat you like an adult. What you say is true, but then also if they need to verify that information with a doctor. But in terms of, I did see this question about wanting to have a phone call with me. One of our things, our philosophies at Skye is we want to actually think about Skye as a business is helping our clients. So any one advisor is not the hero of our business. I'm not the hero of our business. Whether you see, you know, myself, Azaria, Kat, Amy, Eddie, anyone on that screen, the advice theoretically should be the same. And so we've got a very clear process that all of our advisors kind of adhere to in terms of our thought process when it comes to developing and the strategy, the insurance strategy for every individual. And we've been really intentional about getting all our advisors buying into that philosophy. And we update and we change all the time, but all of our advisors have a say in the way we develop our strategy and what makes sense. And then maybe on the margins, two different advisors give you two different pieces of advice, but they will also explain their thought process about why they chose one option over another. Because insurance, it seems simple, just take out income protection, life insurance, TBD, but it is actually really complex when you're looking at existing cover in place, you know, individual health history, builds in a lot of complexity. So, you know, if Amy and Ash came up with different strategies, they would both also explain what the alternative is and why that might make sense for you as well. Because, you know, we're all human beings. We've got to make some assumed or some assumptions about our clients. But yeah, you know, whether or even if I was still giving advice to clients, it would be the same advice that Amy would be giving as well.
So we have had another question pop in. So if an insurance provider excluded a health condition, but you wanted to take the policy due to the other inclusions, can you have that exclusion provided with another insurance provider? So the way that we basically look at everybody's situation is before we look at which insurer we're going to recommend, we go to all of the insurers with all of the health information, de-identify it and ask all of the insurers what they would offer in regards to the terms. And then we use that to determine who we are going to recommend as the most suited insurer. So often if one insurer is going to exclude you for something, other insurers are going to as well. And we're recommending the best out of that group. So you can't, even if there was somebody that was happy to offer you just that the thing that's excluded on another policy, you wouldn't be able to just take out one policy with them for that excluded item and then have everything else with the other insurer. But at Skye, we do look at all of that upfront before we recommend any insurer and determine who the most suited is for you, taking into consideration what they're going to exclude and what they're going to offer as well as part of that process.
Yeah, and to that, my point as well, like coming back to the margins of like Amy or Ashley coming to different advice, like if insurance company A said we'll put a mental health exclusion on the policy, but everything else will be covered, and insurance company B said we'll put a back exclusion on the policy, but everything else is covered, Amy may go, well, I think we should get the cover, with the mental health exclusion and cover the back because there's manual occupation. And that would make sense, that recommendation. And Ash may say, I think we should take the back exclusion and not the mental health because statistically mental health, it makes up a higher percentage of claims for this cohort of individuals. And I understand they're in a manual occupation, but I still make that choice. And so that's where in our advice document, we actually show the two options and we say, hey, here's what the insurance companies have been, have assessed based on that pre-assessment. And, Amy will say, I recommend insurance company A for all these reasons, but insurance company B is a really reasonable choice. And it makes sense if you would prefer that, because at the end of the day, the way we think about our advice is we want to educate our clients to make a really informed decision and then just empower them to make that decision that's right for them. Because, the insurance that I have for myself may not be right for Amy and vice versa. But Amy's is perfect because I gave her that advice. So I think that's it. We've got, we do love feedback as good or as bad. We do love to hear feedback, and this is our last webinar for the year. So keen to hear feedback. We'll likely run webinars next year. We find it a really great way just to continue to educate people on personal insurance, as we saw from the poll at the very beginning. A lot of people are kind of have some basic knowledge, but are here to kind of learn some more. As I said, that's all, folks. That's the last webinar for the year. So thank you very much for coming, and I appreciate it. Thank you, Amy. Great job on your first webinar. You did very well. Here we go.
That's all, folks.
Yes, and hopefully Looney Tunes don't come after us for using it. Awesome.
Thank you, everyone. There, Phil, can we chuck the slides back up to just get that QR code for the feedback?
Feedback.
Yeah,
let's go. Awesome. Thank you, everyone, for coming. I really appreciate it. We're going to close down this webinar now. If you do have any questions, just send us an email, hello@skye.com.au. Awesome. Thank you, everyone.
Thanks, everyone.